Welcome to the webinar on the secret to intraday trading. So, in this webinar, I will be talking about what intraday trading is all about and how you can benefit from it. Also, most popular technical tools which are there to help you identify intraday trends and learn to spot the winners and write them, how you can identify winners in the markets and write them. And most important, what you definitely shouldn't do while trading intraday. So, what are the don'ts? Because it's important that we know the do's, but at the same time we also know the don'ts. So if you look at intraday trading, it's all about how you actually take advantage of market movements and how you benefit from it. So if we just look at a comparison, if intraday trading is like flying, then positional trading is like driving. So it's like if if you look at it, positional trading is like driving, then intraday trading is like flying. So what it effectively means is that if you are a positional trader, you're holding your position for weeks, months, years, then you can relax and you can have your own time. But if you're intraday trading, if you're short-term trading, that means you have to be more focused. And it also is I would say quite I would say takes you on a high in terms of it's an emotional roller coaster ride also for many. So so that's one point. The second is trading is a journey of self discovery. As I said, we at times get into an emotional roller coaster ride in the markets, but emotions are very dangerous in markets. So the more you discover yourself, the more you realize what your strengths are, what your weaknesses are, the better you become and emerge as a trader. So if you look at it, the market hypnotizes traders like a magician hypnotizes a snake by moving his flute rhythmically up and down. So we've seen the snake charmers using their flutes to hypnotize a snake by moving the flute rhythmically up and down. Likewise, if you look at it, the markets hypnotize the trader. You have all the sea of red and all stocks are falling. So one is again emotionally attached to the market, or everything is in blue and the market is rising significantly. There's a broad-based rally. So again, there's another mood. So the market basically makes the trader dance to its tunes. So that's what is very important, that how you can stay away from that dance and how you can look at the market as it really is. Apart from that, it's easy to see good trades in the middle of the chart, but the closer you get to the right edge, the more confusing the markets are. It is also called the fog of war. So what it effectively means is that if you look at the past chart, you can say that, okay, I could have bought here, I could have sold here. But on the right hand side or the right edge of the chart, which is now what is happening, the real time, that's at times very confusing. That's also called the fog of war. So you have fog, you can't see clearly, and there is war that's going inside. So day trading demands that you trade very few liquid and volatile stocks or indices, as it requires immense concentration. So if you're day trading, if you're doing intraday trades, then you have to focus on few stocks or on indices like Bank Nifty or Nifty. You can trade Bank Nifty weekly or Nifty as well. Which are the indices which are extremely liquid? And also, if you're trading stock options, or for the matter, cash or futures, you need to ensure that there is ample liquidity in that particular stock. And most importantly, avoid thin markets in day trading. So markets which are not liquid, stocks which are not liquid, which have a higher gap between bid and ask spread, you should definitely avoid trading them. So if you look at trading, it's like battle, because what you need to understand is that the market is a brutal place. It's not your friend. You can't find friends in the market. So it's a brutal place. It's war. Effectively, you need to understand that. So if it is war, so when you need to pick up a weapon and put your life on the line, would you rather be sober or drunk? So what it effectively means is that if you're getting into war, so will you be drunk or you will be sober? Because if you are drunk, then you really can't be in control of your senses, and you wouldn't know what exactly is happening. But if you're sober, if you have your emotions under your control, then you can very well play a very crucial and successful role in the war. So you have to treat that trading is war, it's battle, so you can't take it lightly. One. Secondly, discipline is necessary for success in most endeavors. Whatever we want to do in life, somewhere or other, we require discipline. But in markets, discipline is even more important because in markets there are no external controls. So what it effectively means that the market allows you to do anything that you want to do as long as you have margin in your account. As long as you have money in your account, you can buy anything, you can sell anything, you can buy at any rate, you sell at any rate, you can buy any quantity, sell any quantity, but no one will stop you as long as you have money and margin in your account. So this is complete freedom which the market offers you, and unfortunately, we human beings, since our birth, have been programmed to live in a structured and controlled environment. So the markets are completely uncontrolled, gives us complete freedom. So we are not used to it. That's the reason people struggle in the markets. That's the reason you need to have some rules for trading or investing, whatever. So it's okay to make mistakes, but it's not okay to repeat them. Generally, what happens is if you're trading in the markets, you buy a stock and then you again, or you realize, okay, you bought it in an emotional state of mind, again you sell and the market bounces back from there. So what you need to understand is that you don't repeat the same mistake again and again, because if you repeat the same mistake again and again, you can't expect different results. But if you want to rise as a trader, if you want to increase your level of expertise, if you want to gain an edge in the markets, then somewhere or the other you need to learn from your mistakes. So intraday trading is also about particular day sentiments, news flows, and trends. So what's happening in the Asian markets early morning? How's SGX Nifty trading? What happened in the US markets last evening? Are there any major data releases which are supposed to come today? Be it, it could be macroeconomic data, that is country specific data release, or it could be company specific data release, some major release, data release, economic release, or whatever for a particular large cap company. So, or even for any stock, if you're wishing to trade that, you should be aware if some key piece of information is likely to come out for that stock. So you can plan accordingly. Then apart from that, intraday leverage is available. So when you're trading intraday short term, you can take the advantage of high leverage. If you're trading futures and options, there the leverage is anyways very high. So you need to understand that leverage is a double-edged sword. Sword. You can make a killing or you can get killed if you don't know how to handle the sword. So if you take advantage of leverage, but you know how to use leverage, then it works to your advantage. But if you take leverage, high leverage, but you don't know how to manage the leverage, then you are in serious trouble. So now we look at the most powerful technical tools to identify intraday trends, and also we look at the various time frames because generally markets are very complex. So analyzing the market in only one time frame is not a good idea. So what it effectively means is that you just don't look at the daily chart and then decide, or you simply don't look at an hourly chart and then decide, or you simply don't look at a 15-minute or a 5-minute chart. Say for example, for liquid stocks or indices like Nifty, Bank Nifty, Tata Motors, Tata Steel, Reliance, some of these stocks. So if you look at this particular slide, what you will see is that long-term investing. From a long-term investing, if you look at it, that's basically into months and years. If I look at positional trade, so that's between days and months. If I look at swing trade, so that is between hours and days. So swing trade basically it could last for a couple of days, and day trading is more about during the day. So these are certain styles of trading which are available. So if you look at this particular slide, you'll find that in this box on the left, you have your year year is there, quarter is there, month. So you need to analyze these different time frames. So we'll talk about the last two, which is highlighted in red. So we if you look at the long term trend, so for that you look at the daily chart, then you look at the intermediate term trend, so you look at the hourly chart, and then you look at the short term trend, which is a 15-minute chart. So that is your for your entry and exit. Likewise, if you want to trade even shorter term, so that is scalping, you want to trade for for a few minutes or so, then for that, your long term becomes a 15-minute chart, your intermediate term trend becomes a 5-minute chart, and your short term becomes a 1-minute chart. So effectively, you have different time frames for trading. So ideally, if you are trading short term, then daily, hourly, and 15 minutes makes more sense. Now we look at technical analysis. Basically, what are the key takeaways here? So you need to understand that price, volume, and open interest. Open interest is valid for the futures and options. These are the building blocks of technical analysis. And the second premise in technical analysis is that market action discounts everything. So what it effectively means is that all relevant information is reflected in the price at any given moment of time. So you don't have to worry as to what information is coming, what information is not coming, because if any information which is relevant and is useful will definitely find its way into the price. So what you need to do is you need to avoid the noise and follow the signal. There's so much of noise that's all around you if you're into trading. So you need to maintain your peace of mind and you need to follow the signal. That's very important. The third is that prices move in trends. You'll find that there's a long-term trend, the intermediate-term trend, which is also called the mid-term trend, and the short-term trend. So you basically got three types of trends. Apart from that, in that again you have an uptrend, a downtrend, or a sideways trend, which is also called a lateral trend. So trend is something which you need to definitely look at, because a trend is your friend till the time it bends. Apart from that, if you look, history repeats itself. So technical analysis, what it does is it captures human psychology, mass psychology on the charts. And if you look at the charts over a long period of time, you'll find the similar patterns repeat itself. And if you spend the time learning that, you can definitely emerge a winner. Apart from that, there are popular chart types. Earlier in, I would say many decades back, it was the line chart. Then we had the bar chart. Then we had the point and figure chart. And then we have the Japanese candlesticks, which are currently the world's most popular. They also are early warning signals. So you get early warning signals using Japanese candlesticks uh, as charts. We have a particular a webinar on Japanese candlesticks itself. So if you want, you can attend the same. Now we look at some of the most popular technical tools to identify intraday trends. So what you need to understand here is that there are hundreds and hundreds of indicators. Now, if you look at too many indicators, what will happen is that you'll get confused. Some are giving buy, some are giving sells. What effectively you do? And also, there's a very nice saying which goes that too much analysis leads to paralysis. So if you're analyzing too much, then your chances of decision making reduces significantly, and most importantly, your chances of timely decision making decreases significantly. And as intraday short term is for very a short period of time, you don't have that much luxury. So you need to define your rules prior to entering a trade. So we've got different types of indicators. If you look at this particular box, you have trending indicators, you have non-trending indicators, which are also called oscillators. So trending indicators, like we have the moving averages, we have the MACD, we have the ADX, we have the super trend, and non-trending we have like oscillators, we have like RSI, stochastics, which are basically telling us whether the stock is moving in overbought zone or oversold zone. So these are some of the popular tools which are used for moving averages. So if you're looking at a short-term trade, then ideally using a 10-period exponential average is the best. That gives very good results. There's a lot of study being done globally as to which are the best averages to be used for a short-term trading perspective, and the 10 EMA period comes out on top. Then we have the MACD, that is the moving average convergence divergence. Looking at the histogram is more appropriate. It gives you a very good idea as to the trend, whether the trend is positive, the trend is negative, and whether the trend is accelerating or deaccelerating. So that also is something which can help you. So you need to look at the histogram. That is the chart which is made of the MACD. So here you use the parameters 12, 26, 26, and 9. Again, all exponential moving averages. Then we have RSI stochastics. Basically, these are non-trending indicators like oscillators. So they tell us that a market is likely to trade in a range, and the market is in oversold territory. So there is a possibility that the stock could bounce back or the market could bounce back. Likewise, if it in overbought territory, there is a possibility that we could witness a correction or profit bouquet. So generally, 14 period is the default parameter that is used for RSI stochastics. You can have your own version as well. Then there's something called the ORB, that's the open range breakout. Open range breakout, what we find is that you should avoid trading during the first 15 minutes or first half an hour of the day until unless you have some very valid reason. Because generally we find that sometimes the market opens with an up gap and that's the high of the day, and the market corrects significantly from there. Or secondly, it could happen that the market down gaps and then that's a low of the day, and from there the market bounces back. So you need to understand that the first 15 to 30 minutes, let the market settle down, and then you should place a trade. Don't be in a hurry to place a trade, because that means if you're in a hurry to place a trade, that means you are trading more on your emotional part rather than on your logical part. Then apart from that, we have something called Bollinger Bands. Basically, we'll be looking at examples also. So Bollinger Bands is basically an indicator developed by John Bollinger, which talks about a band that measures the standard deviation and volatility. And it is very useful. I'll show with an example how it's useful. Then apart from that, we have support and resistance levels. So support and resistance levels are very crucial, very important. Support you can understand as the floor, and resistance as the ceiling. So the stock is trading within this range. So once the prices breach above the resistance zone, that in turn now becomes the support. So understanding what are the support levels from a long-term perspective is also very good for stocks or indices. And last, we have the pivot levels. So pivot levels are again gives you the levels for support and resistance. So that's something you can definitely look at. Now coming to our Angel mobile application, we see we have charting available. We have charts, very good quality, high quality charts are available on our Angel mobile app. You can definitely use them, and also you have hundreds of most popular indicators which are available on the application chart. Now we look at some examples, so you'll get a good idea as to how to trade and spot winners. Because till now I was talking about the indicators, but here I give you with an example as to how you can place a trade. So you can see that there are three charts in this. This is of Adani Enterprises of 25th October 2018. So on the left hand side, you see that the first chart is a daily chart. If you can look at the bottom here, you have this daily chart here. So what if you can see that the trend for Adani Enterprises is up. So you have the MACD is trading positive, is positive. That is about this is a zero line. So it's trading positive and strong. And you see this 10 period EMA, this green line, that's a 10 period EMA. So the stock is trading above that. So what it effectively means is any dip in an hourly chart. So here we are have seeing the same of Adani Enterprises during the same period. This is a daily chart. We are seeing an hourly chart. So in hourly chart, what we are seeing that the stock is trading in the oversold territory. Here the MACD is definitely negative, but since the long-term trend is positive and strong, so you can still look at that ignoring this. So in this case, what happens is that on the hourly chart, you have the stochastics 14 period RSI. So the stochastics is below 20. So what it effectively means is that the trend is strong on the daily chart. On the hourly chart, it is oversold territory. So now you come to look at an entry point. So in this case, what you do, you use a 10-minute chart here. So you use a 10-minute chart. You can also use a 15-minute chart, but 10-minute tends to give you faster signals. So what you need to understand here is that we are using Bollinger Bands, this green line and this brown line. So you can see that prices are closing below this lower line, but here the candles are closing inside the lower band. So this is an indication that this can be a good time to buy. So you can look at it that Adani Enterprises that was on this 25th October, you had it trading close to 162 levels. So once it moved outside the band and then inside the band and you bought it, so from there it rallied all the way to 174 levels. So you can see that this can be a very good opportunity. So if you follow the simple strategy also, it can help you significantly. Now, if you are an investor, if you're a long-term investor, so what you can do, you can replace the daily with a monthly, you can replace the 60-minute with a weekly, and you can replace the 10-minute with a daily and use the same strategy. If you have any queries, you can always write to us at webinars@angelbooking.com, and I will ensure that your queries are addressed. Likewise, we look at another example using the same strategy, and that's the short call again on 24th. This is on 24th October. This is for Cadila, the pharma space. So here, what we can see is that the MACD is negative, or it is a daily chart. It's been negative for quite some time, and the 10 period EMA is sloping downwards. So what it effectively means is that any pullback should be used as a shorting opportunity. So in the second this graph, what we see is that on a 60-minute chart, we see that the stochastics has moved in an overbought zone. So the stochastics has moved in an overbought zone. So this is it. So here, if you see the stochastic has moved in an overbought zone. And now you look at a 10-minute chart. So here you find that the candles are closing above the green line, which is the upper band. And then once it closes inside the upper band, that is a sign that you can sell this particular stock. So you see that the selling is around 378 levels. From there, the stock corrected to almost 342 levels. So effectively, this is a very good mechanism, wherein a very good strategy, wherein you can implement both long and short. And as I explained, the strategy, it's a very simple but very effective strategy. You can try it out. If you have any queries, suggestions, ideas, you can definitely write to us at webinars@angelbroking.com, and we'll help you address your queries. So what we see is that the key takeaways from this is how do you spot the winners and ride them is if you're trading intraday short term, don't focus on too many stocks, because that way you will get deep focused, and then you'll miss the most the best of the best trades. So what you need to look at when you're trading short term is that it has to be a liquid, most liquid. There is the least bid and ask spread, and the stock is highly volatile. So that gives you an opportunity. And also, what you need to understand is that don't try to run after or chase a running market. Rather, you should place limit orders because they work best for entering trades. And as I had explained earlier, opening prices reflects opinion of less informed market participants. So once the market opens, it's generally the less informed market participants who step in. So as far as possible, avoid trading in the first 15 minutes to 30 minutes of the day. Let the market first find its level, and then you enter the stock or the index. And if you want to enter prior to that, then you should have some valid reason as to why you are trading the first 5 minutes or 10 minutes of the day. So in moving averages, what's most important is the slope of the moving average. So you need to watch out for the slope of the moving average. So I'll just go back to a previous slide. If you look at this particular slide, so you see that the 10-period exponential moving average is sloping down, and this also is negative. So it means that the possibility of a further correction is there. Likewise, I'll go back to the previous slide. So if you look at this Adani Enterprises, this green line, it is sloping upwards. So what it effectively means is that any dip can be used as a buying opportunity. So this dip is here on the hourly chart, which is in oversold territory. On the 10 minutes chart, this is in below the Bollinger Band, closes inside the Bollinger Band, and here we have this significant rally. So you can definitely try this strategy out, and if you have any queries, you can write to us. So as I was talking about, the slope of the moving average is most important. You need to watch out for the slope. And MACD histogram helps identify the best buying or shorting opportunities. So where both the moving average and the MACD histogram are in gear, there you get the best of the best trades. So if you look at it, intraday secret, that's more of what it effectively means, that you have to look at the slope of the moving average and the slope of the MACD histogram. So if both are up, then it's basically green, means it's both are indicating a positive stance. So you have a green light. So what it effectively means is that either you can go long or stand aside, but no shorting. Likewise, if it is red, meaning what? The slope of the moving average is down, slope of MACD histogram is down, and it's negative. So in that case, you need to short or stand aside, but no buying. So the trend is down, so you don't buy. You actually look at shorting opportunities. And there are two cases of blue, wherein in one case the slope of the EMA is up, that is the exponential moving average is up, and in second case the slope of the MACD histogram is down. Likewise, in the next case we have the slope of the EMA is down, whereas the slope of the MACD is up. So we see that neither the EMA and the MACD histogram are in gear, that is both are not at the same time either up or down. So if it's like up and down and up and down and up, so either you can go long or short, or better you avoid. So ideally you should look at identifying those stocks which are in gear both in the EMA and the MACD histogram. They will give you the best rates. So finally, there is one important point that you need to understand is that there is only one rational reason to trade, and that is to make money. But generally, what happens is that the market and the money attracts traders to the market, but in the excitement of the new game, they lose sight of that goal. So markets are, I would say, the most seductive place on earth. They really seduce us to take into all wrong decisions in the market. So you have to control your emotions. You have to have rules of the game. Just like if you play cricket, you play soccer, you have the rules of the game. Likewise, trading is also, need to have some rules of the game. because that will help you stay calm in an otherwise irrational market at times, a chaotic market at times. And also, as I had explained earlier, market is actually war, so you need to keep your senses under control. Apart from that, you also learn to manage your risk. That's very important. Managing your risk is very important. How much risk you need to take on a particular trade, that again is very important. So ideally, you should not risk more than 2% to 5% of your total capital on one particular trade. So if you are risking 5%, so effectively what it means is 20 trades going wrong will wipe out your capital. Likewise, if you are risking 2% on a particular trade, so it effectively means that 50 trades going wrong will effectively wipe out your capital, which is unlikely to happen. So you need to manage the percentage of risk that you are taking on one particular trade. So the percentage of risk is a factor of your trading capital. So if you really follow these rules and strategies, you can step out and stand out from the crowd. That means you have gained an edge. And once you've gained an edge, then the possibility and the probability of you succeeding in the markets is very high. Thank you.